We just got the April jobs report this past week. The U.S. economy added 115,000 jobs last month. Economists were forecasting 62,000. So the labor market nearly doubled what Wall Street expected. Retail trade specifically added 22,000 positions in April. That is which your tenant's industry lies in. Unemployment held steady at 4.3%. By that scorecard, things look resilient, and they are partly. But here's what the jobs number does not tell you. The University of Michigan surveys of consumers, also released this past week, showed sentiment dropped 3.5 points this month. We are now at a level comparable to the troughs seen in June 2022. That was not a good period. More importantly, year-ahead inflation expectations surged from 3.8% to 4.7% in a single month. That is the largest one-month jump since April 2025. Across all income levels, all political affiliations, all ages, this was not a partisan reading. It was for everyone. So you have a labor market holding its ground and a consumer mind that is deeply spooked. That is the core tension of this week. Tie that into your strip center. Employed consumers still drive strip center foot traffic. That base is not broken, but spooked customers spend differently. Fewer impulse buys, more deliberate choices, more value seeking. Tenants whose concept depends on spontaneous discretionary spending face a headwind. The Conference Board's April Consumer Confidence Survey told us exactly how consumers plan to spend over the next 6 months. The phrase they used, spending is concentrating in cheap thrills and necessary services. The top expected spending category, restaurants, bars, and takeout. Number 1. Beauty and personal care came in strong, health and personal care, utilities, and healthcare. So what dropped? Travel, big ticket purchases, anything discretionary and expensive, and QSR is gaining foot traffic as consumers trade down from fast casual, where some major brands have seen same-store sales go negative. This is a tenant mix playbook written in plain numbers. Retail properties that have QSRs, neighborhood restaurants, beauty, health services, and value retail are aligned with where consumers say they are putting their dollars. Strip centers with heavy apparel, home goods, or entertainment-oriented concepts face a more selective traffic environment. The Conference Board data names the top spending categories explicitly: restaurants, takeout, beauty, personal care, health services. QSR is gaining market share from fast casual as consumers trade down, a traffic driver for strip centers with drive-through or QSR formats. In value retail openings, think Dollar General, Aldi, Tractor Supply, are leading the new store expansion nationally in 2026. The best strip center tenant alignment is shifting toward that tier. Before any of those spending decisions get made, the pump takes its cut. The national average for a gallon of regular gasoline is $4.55 this week, according to AAA. That is up 25 cents for the second straight week, and it is $1.40 higher than it was a year ago. That spike traces directly to the Iran situation, obviously. The Strait of Hormuz conflict that has been running since earlier this year. Oil markets have been whipsawed all week by ceasefire rumors and breakdowns. On May 4th, the 30-year Treasury yield briefly topped 5% on energy and inflation fears. As of Friday, reports suggest a U.S.-Iran framework agreement is close, and yields have pulled back to the 4.38% range on the 10-year. If that deal holds, gas prices ease, inflation expectations cool, and borrowing conditions get marginally friendlier. If talks collapse, $5 gas is back on the table, and the pressure on the Federal Reserve to stay frozen intensifies. For your tenants, $4.50 per gallon of gas is a direct tax on your customers' discretionary budgets. Every dollar at the pump is a dollar that does not make it into your strip center. On April 29th, the Federal Reserve held interest rates unchanged for the third consecutive meeting, keeping the target rate at 3.5 to 3.75%. That was expected. What was not typical, the vote was 8-4. 4 officials dissented. That is the most divided Federal Reserve vote since October 1992. One dissenter wanted to cut rates immediately. 3 objected to language that even suggested cuts might be coming. That is a committee that cannot agree on direction. And on May 15th, 1 week from today, Kevin Warsh takes over as Fed chair, replacing Jerome Powell. Now, he inherits a committee divided 4 ways: a 10-year Treasury at 4.38%, and inflation expectations that just spiked to 4.7%. The incoming chair has no easy path. Markets are currently pricing only about a 20% probability of any rate cut before September or October. The higher for longer story is not over. It just has a new author now. For retail center owners and investors, the borrowing rate environment remains constrained. Add a typical lender spread of 200 to 250 basis points to a 10-year at 4.38%, and commercial mortgage rates are running in the 6.4 to 6.9% range, depending on the deal structure. That affects your debt coverage ratio, your cash-on-cash return, and the size of the buyer pool you can reach on any asset. Coreside Research projects roughly 7,900 store closures nationwide in 2026. The names rolling through right now include Francesca's, all 400 locations liquidating, Saks off 5th with 57 closures in their bankruptcy restructuring, Kroger closing about 60 underperforming locations over 18 months, and Walgreens continuing a multi-year plan to close 1,200 stores. On the opening side, Dollar General, Aldi, and Tractor Supply are leading expansion. This is the value tenant migration story in real time. Discount grocery, dollar format retail, and essential convenience are actively expanding, and they are looking at strip center space, at least some of them. New strip center construction remains constrained by elevated labor and borrowing costs, which means well-located existing space is genuinely scarce. 4 things to hold on from this week. 1, the labor market is holding. 115,000 jobs added in April, nearly double expectations. Your tenants' employees are still showing up to work. 2, the consumer is scared. Sentiment is at a 4-year low. Inflation expectations just had their biggest monthly spike in over a year. Gas is at averaging $4.55 nationwide. The spending that does happen is deliberate and value-driven. Number 3, the Fed is frozen and about to change leadership. The rate environment continuing to make deals hard is not going away in the next quarter. And finally, number 4, the tenant mix rotation is real and accelerating. Value retail and essential services are expanding. Discretionary mid-tier is contracting. Where your strip center sits on that spectrum matters more right now than most anything else. If you own a strip center in San Antonio, Austin, or the Rio Grande Valley and want to talk through what this environment means for your specific property, please feel free to reach out. Anywhere else in the country, if you need a second look at your deal, be happy to do it. That's exactly the kind of conversations I have with the clients every week. So feel free to reach out. Until next time, take care.